Morning, everyone, and welcome to Sidoti's Small Cap Virtual Conference. I'm Steve Ferrazzani, an analyst at Sidoti. So pleased to be joined this morning by CEO Neil Lux of Forum Energy Technologies. The ticker is FET. We launched coverage just a month ago. If you haven't seen the report, please reach out to your institutional sales rep. Otherwise, it's on our website. You can find it on Bloomberg or FactSet. We did initiate with a $24 price target, citing FET's strong global presence and ability to generate cash flow. Again, if you have the chance, check out that report. I know Neil will cover a lot of these topics during his presentation. We will have time remaining after the presentation for questions. If you have any, press that Q&A box at the bottom of your screen, type them in, and we'll get to absolutely as many as we can. And with that, let me turn it over to CEO Neil Lux.
Thanks, Steve. Good morning, everybody. I'll begin with just a quick introduction. I joined FET about 8 years ago. I was adopted through an acquisition. I was a founder of a company called Global Tubing, which remains one of FET's key product lines today. I've been in the energy equipment manufacturing industry for 20 years. And in addition to my operating roles, I've been involved in a lot of product development and innovation through that time. For example, I developed a patented product that has generated a significant amount of revenue over the last 13 years for Global Tubing and FET. So innovation has been a key part of my success and remains in my DNA and FET's. So with that, I'm going to jump ahead to slide 3 and really begin with FET at a glance. So we don't drill wells, we don't drill holes, but we sell critical capital equipment to industry leaders that do. We don't stimulate wells, but we manufacture consumable products that enable the world's largest service companies to do so. And we don't produce hydrocarbons, but we do engineer and deliver specialized downhole tools for our blue chip customers to optimize oil and gas production. We make it happen by manufacturing value-added products and solutions that increase the safety and efficiency of energy production. So we are a global manufacturer. Almost all of our revenue is derived from selling new products and solutions along with aftermarket parts and service. We have a wide range of differentiated products in our portfolio, and our deep base of industry knowledge allows us to develop new solutions for our customers and separate ourselves from our competition. We report our financials through 2 segments, our artificial lift and downhole and drilling completion segments. Within our artificial lift and downhole segment, we have 3 product lines: downhole, production equipment, and valve solutions. Customers in this segment include global energy companies who own and process hydrocarbons such as ExxonMobil, Aramco, and Canadian Natural Resources. The products in this segment support maintaining production, protecting downhole pumps, increasing wellbore efficiency, and removing impurities from hydrocarbon production. Within our drilling and completion segment, we have 4 product lines: drilling, subsea, stimulation intervention, and coiled tubing. The products in this segment are critical to new production, such as pipe handling equipment for drilling rigs, subsea robotics for deep water tree installation, and coiled tubing, wireline, and high-pressure pumps for well completion activities. Customers in this segment include the largest oil field service companies such as SLB, Halliburton, and Baker Hughes. And as a truly global manufacturer, about 50% of our sales are realized outside the United States. Finally, moving to the chart to the right, our financial performance demonstrates steady improvement. Revenue has grown at a compound rate of 15% since 2021. EBIT has grown much more quickly at over 70% annually. We have improved our EBITDA margins from under 4% in 2021 to over 12% in 2024 by reshaping our product portfolio, commercializing new value-added technologies, and completing accretive acquisitions. Financially, FET is in its strongest position in many years. This is who we are, but I think for this audience, the more important question is why? Why FET? Why is FET a great company and better investment? First, the world needs energy. Energy is the fundamental building block of economic growth. Demand will propel strong global investment in energy production, and our blue chip customer base will look to FET to provide the tools to safely and efficiently produce more energy. This will drive revenue growth since our products are critical components and demand for them will grow. As a manufacturer, our operating leverage will drive margin expansion. In the long run, for every $100 increase in revenue, $30 to $40 will drop to EBITDA. These are strong incremental margins, and with our capital-light business model, we will convert a significant percentage of incremental EBITDA into free cash flow. Finally, we expect to continue to reduce net debt while buying back our shares. And with our current free cash flow yield, FET is an incredible investment. So let's spend the next few minutes diving into more detail on why FET. The world needs energy a lot more. Several factors drive energy demand growth. Population growth, more people, more energy required. Energy security. With conflicts in the Middle East and Ukraine, energy security is vital to geopolitical strength. Quality of life. There are 6 to 7 billion people in the world who consume a fraction of the energy we do in the West. As quality of life improves for these people, they will consume more energy. And a newer driver of energy demand stems from growth in data centers and artificial intelligence. The amount of energy needed will be staggering. Consistent with these drivers, the U.S. Energy Information Administration, or the EIA, estimates global energy demand will increase by 30% over the next 2 decades. So where will this energy come from? First, non-fossil fuel sources such as renewable energies, they will have their place. But importantly, fossil fuels will remain a significant contributor to overall global energy supply. Politically, support for fossil fuels is at its strongest in many years because this source of energy is highly reliable and abundant, while alternative sources have many years of technology development to overcome their inherent intermittency. And according to the EIA, energy supply from fossil fuels will satisfy around 2/3 of energy demand by 2050, even after forecasting rapid growth in alternative fuels. Interestingly, given the support for political support of fossil fuels, it is entirely possible that this chart underestimates future demand significantly. So how does this future supply growth impact FET? So while we have a broad portfolio of products and solutions across the energy value chain, the primary driver of our revenue is industry activity. We measure industry activity using the number of active drilling rigs on a global basis. Chart on the left illustrates our strong revenue correlation with global rig count. Therefore, as growing demand for energy drives investment in new oil and gas supply, the resulting activity will drive FET revenue. Moving to the right side, about 80% of our sales are from activity-driven consumables. Our consumable products represent a small share of our customer spend, but they are critical. Generally, our customers cannot complete or drill wells without our products. And our consumables are not just, nuts and bolts. These are big ticket items with unit prices usually in the thousands, if not hundreds of thousands of dollars. The remaining 20% of our revenues are from longer-lived capital equipment. This revenue source provides an upside growth driver in the event global demand increases meaningfully. Our capital equipment includes equipment for land and offshore drilling rigs, deep water subsea robotics for traditional oil and gas and for offshore wind, and pumping equipment for well stimulation. Finally, as illustrated in the lower left part of this slide, FET's revenue per global rig has increased over the past few years. This growth highlights another driver of our results, and that is service intensity. Service intensity reflects the fact that drilling rigs will drill more feet per day and frac fleets will pump more stages per day. These factors increase the amount of wear and tear on equipment and drive FET's consumable revenue. Additionally, increasing revenue per rig is indicative of FET's expanding market share through our growth strategy, which I will outline on the next slide. We are strong believers in energy. We believe there's a long tailwind in demand for our products. But to deliver exceptional value for our shareholders, we need to beat the market. Our beat the market strategy consists of 4 parts. 1, grow profitable market share through FET's competitive advantage. Develop differentiated products and technologies for the markets we serve. Utilize our global manufacturing and distribution footprint to service our customers anywhere in the world, and expand our participation in new energy. Our success with this strategy will drive revenue growth faster than the overall industry. So let's spend some time on each of these pillars on the next few slides. Over the past few years, we have strategically shifted our portfolio to ensure we compete in markets with certain attractive characteristics. We focus on niche markets with limited competition and where we have meaningful market share. About 2/3 of our revenue comes from these leadership markets, and most of our competitors here are smaller, privately held companies. This allows us to compete where we have a differentiated advantage. Within our niche markets, we erect high barriers to entry with intellectual property, specialized manufacturing, and decades of continuous product innovation. Then we use our close customer relationships to facilitate further innovation and ensure continued relevance of our solutions through market cycles. And with our dedicated manufacturing sites, we can quickly ramp up production to meet demand and establish a leadership position. We believe we can capture market share over time and realize the compound revenue effects from our efforts. And with the second pillar of our strategy, innovation, we can supercharge these efforts. New product development and innovation are critical to beating the market. Operators are demanding greater efficiencies, lower well costs, and increased safety. To remain relevant, our customers must upgrade their capabilities. By innovating and working together, we make them safer and more efficient. And this is FET's opportunity to increase our total addressable market. On the right, we have 3 examples of products FET provides and developed through customer collaboration. First is the EnviroLite greaseless cable. This is a specialized cable that can run in and out of the well much faster than traditional cables. This eliminates wasted steps and allows for more pumping time per day. The next example is DuraCoil coil tubing. To increase performance and reliability in high-pressure operations, we developed and patented an inline quench and temper process for coil tubing. This process significantly enhances the fatigue life of coil tubing and allows us to garner a premium price. Final example is Variperm Energy Services sand and flow control solutions. Variperm was a fantastic acquisition we closed over a year ago. They have a differentiated product offering in the sand and flow control niche market. Their customers, who are operators, provide core samples from their production reservoirs and the Variperm engineering and sales team customizes a solution specifically for their wells. This customization, along with 5 decades of brand awareness, make Variperm the market leader. These are just a few examples. Again, at FET, we have technology in our name and innovation in our DNA. And we will use our global manufacturing and distribution footprint to deliver our innovations around the world. At FET, we have an extensive global reach. About half our sales are outside the United States, with roughly 20% of our sales for offshore applications. We ship to virtually every oil and gas producing region, as illustrated by the map on the right. To support these sales, we have 44 locations across 9 countries, staffed by a global team of about 1,800 employees. This includes key manufacturing locations in the US, Canada, United Kingdom, Germany, and Saudi Arabia. To meet growing global demand and to provide our products around the world, we do not need to expand our roofline or invest additional capital for growth. We have the footprint in place to expand our revenue by 50% with very little growth CapEx. This is a great feature of our business model. At FET, we will use our core competencies of manufacturing, engineering, and supply chain to address the energy needs of today and tomorrow. We have products that are suitable for biogas, hydrogen, and geothermal applications, and others that can capture methane and carbon. A couple of areas where we have seen meaningful demand is offshore wind and mobile power generation. Our products, specialized remote operated vehicles or ROVs, are dual use for traditional oil and gas and the development of offshore wind farms. The great part is we share the same client for both industries. And we are a critical supplier of heat exchanging equipment for mobile power generation. Supporting development of alternative energy also aligns with our core values and commitment to sustainability. We strive to be good stewards of the environment where we work and live. We strive to be a good place to work where our employees thrive in their careers, and good governance is non-negotiable. We've discussed how we can grow into the future. Now let's take a look back at our financial results over the past few years. As I mentioned in the beginning of the presentation, we have demonstrated strong revenue growth and EBITDA over the past few years. Now let me walk you through our thoughts on this year, 2025. In February, we expected 2025 to be a transitional year for market activity, driven by geopolitical and macroeconomic uncertainty. We had anticipated global drilling and completions activity to be about 2 to 5% lower than 2024 levels. However, we expected to gain continued market share gains through our beat the market strategy would partially or fully offset the impact of lower market activity. Therefore, our adjusted EBITDA guidance range of 80 to 85 to 105 million, with free cash flow guidance between 40 and 60. That was our call in February. Since that call, U.S. trade and tariff policies have generated significant uncertainty. In addition, OPEC Plus announced faster supply growth than previously anticipated. The combination of these events has put pressure on oil prices, which have been hovering near 4-year lows. So while we have not seen a change in market activity, in our experience, rig count declines tend to lag commodity prices by 3 to 6 months. Given this uncertainty, we are taking and have been taking proactive measures to mitigate these impacts. First, to overcome tariffs, we are passing through price increases. In March, we announced price increases to our customers. Second, we are optimizing our supply chain by leveraging our global footprint. Good example of that is we are increasing assembly activities in Saudi Arabia and Canada to avoid tariffs coming in and out of the United States. Also, over the past several years, we have strategically de-risked our supply chain to minimize dependence on a specific country and provide optionality in sourcing. And third, we are reducing costs and inventory. We are aligning costs and managing inbound material orders to carefully align with the business with market conditions. And we initiated actions to eliminate 10 million of annualized costs. On an earnings call last month, we laid out a scenario where if commodity prices don't rebound from current levels, we could see a decline in revenue starting in the third quarter. In this case, we believe our full year EBITDA would be around 85 million. More importantly, though, with our mitigation efforts, we are confident in our previously announced guidance range of 40 to 60 million in free cash flow. This result would allow us to execute meaningful share buybacks and significant debt reduction. So let's spend some time on shareholder returns. First, we have a proven track record of substantially strengthening our balance sheet. In the upper right, you will see our net leverage ratio declining from 4.7 times in 2019 to just over 1.5 at the end of the first quarter of 2025. Over this time, we were able to accomplish this reduction through a combination of debt to equity conversion, organic debt retirement, and refinancing. Our debt maturities extend out to 2028 and 2029. Second, we have generated positive free cash flow for 7 consecutive quarters. Over the past 2 years, we have transformed our business systems and reinforced these improvements with key performance indicators and financial incentives aimed at strong, repeatable free cash flow generation. We envision FET being a cash flow engine. At the left side, we have laid out a plan for the uses of cash that create value for our shareholders, build off our strong balance sheet, and continue free cash flow generation. We will utilize 50% of free cash flow to further reduce our debt. We are committed to maintaining conservative net leverage. The remaining cash would be used for strategic investments, including share repurchases. We have a 75 million share repurchase program in place. That represents just over a third of FET's market cap, highlighting the confidence our directors have on our ability to generate strong free cash flow in the future. Financially, FET is in a great position. To sum it all up, why FET? We believe the investment case remains strong. This belief is based on our track record of significant outperformance, the incredible value of our stock, and our long-term growth potential. We have the resources to execute our beat the market strategy and generate sustainable free cash flow. Today, our free cash flow yield at the midpoint of our guidance range is around 25%. Very few stocks trade at yields this high while also having FET's long-term growth potential. This unlocked value makes share buybacks extremely compelling. Since we announced our buyback authorization in December 2024, we have outperformed the Oilfield Service Index, the Russell 2000, and the average of our peers by significant margins. This performance has confirmed our buyback thesis, and we will seek to buy as many shares as possible within our returns framework. The pieces are in place for a great run, and we are confident the employees of FET will deliver. And together, we will unlock unrealized shareholder value.
Thanks so much, Neil.
Yeah.
We have about 5 or 6 minutes remaining. If you have any questions, press the Q&A button at the bottom of your screen, type them in, and we'll get to as many as we can. Neil, I want to kick it off, just ask a little bit about, you had a slide regarding product innovation. We certainly know in North America, investors are pressuring producers to operate within cash flow. Does that make innovation less important where clearly they are being directed by investors to focus on price?
Yeah, I think what we find is that our products, our innovation, make the process more efficient, right? So if we're
Okay.
more efficient, you're ultimately gonna lower the cost. So I think we can get a higher margin by providing our consumables that last longer, for example, or that make the process more efficient, while lowering cost for lowering expenses for our customers. So I think it's a win-win for both of us. So yeah, the focus on cash for our customer base, just like the focus we have, makes innovation, I think, even more important today.
Okay. Okay. Now, we know that lower oil prices, you covered why rig count, certainly short cycle US land. We're seeing some impact, probably gets impacted into the third quarter. But you have the global diversification. You also have that significant offshore piece, which you reported pretty good backlog and a strong results in Q1. What can you tell us about what's going on with your subsea business and why that's been so healthy?
Yeah, no, we're excited about the subsea business. It's couple really secular factors, right? The last really big build cycle for capital equipment in the subsea product line occurred more than a decade ago. So
Yeah.
the equipment is getting older, and the utilization of the equipment we've sold a decade ago is really high. So our customers need to upgrade. They need to buy new equipment. So we have that going for us. We've also innovated there. So we've created,
Okay.
our Unity operating system that, again, going back to the cost and efficiency question you had earlier, our Unity operating system removes personnel from expensive offshore vessels and allows them to operate from shore. So that's a huge, a huge improvement in efficiency and lower cost for our customers. So subsea going really strong. We're also, what's interesting there, and we haven't talked a lot about it, is our subsea business also has defense applications. So we are seeing more defense interest in our applications there. So that's progressing well. So we have, I think, a strong order book, a lot of opportunities that we're seeing on our subsea side. And again, I think it's good to show the diversification of our product portfolio. So U.S. land may be a little weak here for the next six to 12 months. I think Canada oil sands will continue to be strong, as
Yeah.
well as our offshore subsea business.
I, going back to some of your closing comments regarding the share buyback and also the reiterating of the cash flow guidance. That's a lot of the questions we've gotten in the last month or so since we launched coverage, and you have conviction there. And I think if you could explain a little bit, because oilfield service names typically struggle to generate cash flow in a slower market. The
Mhm.
difference is you're a manufacturer and your CapEx at 1% of sales
Mhm.
is phenomenal in any industry. If you
Y-
can walk through a little bit about the ability, if people don't understand it, to generate cash flow
Yeah.
in
No,
differing markets.
that's it, right? So we're a different model. I think unfortunately we get lumped into oil field services as an industry, but we are a manufacturer. So our CapEx requirements are really low, as you said, less than 1% of revenue. Our main capital requirement or capital use need, let's put it that way, comes from working capital. So it's receivables, it's inventory. So that's why we talked about some of the mitigation efforts that if we see slower demand coming, we're going to reduce inbound material orders so that rather than having inventory on hand that we can't sell, we're only going to have on hand what we can turn into cash very quickly. So I think that's a big differentiation in our model versus our customers who, they do a lot of great stuff. They have a lot of good leverage, but they cannot generate free cash flow like we can.
Okay. Do you think the market is still not quite getting it? Because as you noted, at a 25% cash flow yield is pretty astonishing. particularly the balance sheet and the fact you have the buyback in place? Do you think people just want to see you buy back shares? What do you
I,
think does it?
No, I do think, when we talk to investors, they do want us, they're very curious about when we're going to start buying back shares more. We have the plan in place.
Yeah,
We have an incurrence test with our bonds where we need to be under 1.5 times leverage. So for us, we don't really want to be buying back shares above that anyway. So we think
yeah,
that's a good limit. But our focus on, what we're going to do with the free cash flow, right? We're going to continue to reduce debt
yeah,
and we're going to make strategic investments. So I think we have a good long-term growth strategy that doesn't require a lot of capital. And when we
yeah.
generate the free cash flow from execution of that strategy, we can be investors. And again, FET is a compelling investment to us today.
Does that rule out? I mean, the Variperm acquisition, you've shown the phenomenal performance already. If
Mhm.
another Variperm falls in your lap, does that preclude you?
No, I mean, again, it's the best investment we can make with our free cash flow. We would, let's say, compare another investment with our own stock, right?
Yeah,
And so I think the best result is we continue to generate free cash flow, but our yield goes down to 10%, right? Which I think would make sense. And then
every investor would be very happy, no
every
doubt.
investor would be happy. We'd all be happy. Then we could compare that to other alternatives with our cash.
Perfect. Covered a lot of ground today, Neil. Any closing remarks? We're a little over time, so before we wrap it up.
Yeah, no, again, I appreciate the time today. Again, I think we have a great story. I think we're compelling value, and we are delivering on the promises we've made in the past, and we'll continue to do so going forward.
Excellent. Neil Lux, CEO of Forum Energy Technologies. The ticker is FET. Neil, thanks so much for sharing the story today. And thanks everyone for joining us and hope you enjoy the remainder of Sidoti's virtual investor conference. Thanks, everyone.
Thank you.
Thanks, Neil.